They don't care about the relationship between real interest rates and the price of gold. They don't care about the strong dollar. They don't care about any of this stuff. They don't care about these correlations, right? They just...
Andy Schectmen discusses factors that could potentially lead to a significant rally in silver prices, surpassing current levels. He highlights the increasing physical demand from countries like China and Russia, who are both accumulating and producing large amounts of silver. This demand, coupled with the strategic accumulation by central banks, could tighten available supplies and drive prices up. Schectmen points out price discrepancies on the Shanghai exchange compared to Western markets, indicating arbitrage opportunities that could further elevate prices. He also suggests that traditional mechanisms for price suppression, such as futures contracts and naked short selling, may be weakening. This perceived failure could shift market preference from paper to physical metals, boosting demand for actual silver holdings. Additionally, increased insistence on physical delivery over paper claims could stress the markets if supplies are inadequate, potentially causing a rapid price increase. These market dynamics, alongside geopolitical and economic shifts, particularly from BRICS nations moving away from the US dollar, support the potential for a significant silver market rally driven by both speculative interest and fundamental changes. Financial stresses could trigger silver investors to secure more physical holdings, leading to a further squeeze on prices. This amalgamation of factors, from heightened demand and arbitrage to geopolitical shifts and a weakening in price suppression mechanisms, could significantly influence silver's global market, paving the way for a major price rally. Such dynamics reflect not only the current economic conditions, but also the strategic movements by significant global players in precious metals markets, underlining a robust potential for increased silver prices driven by both market fundamentals and speculative activities.
Pulled that out of my head because everyone was so bummed out that when Rickard said there'd be a new settlement currency in August in Johannesburg, and I had the luxury of spending some time with him right before he made this, or right after he made this announcement, and talk with him about it. And he'll be right, just like I've been saying forever. For 2 years before he said it, that the Shanghai Cooperation Organization and the Eurasian Economic Union will join, and they will. The president of Belarus is calling for a summit to make that happen, to join the BRICS. The reason they didn't do it and issue it is exactly what you're saying. They needed to have the infrastructure in place. So 10 countries is impressive. How about 36 countries? How about 46? How about controlling the Red Sea and the Straits of Hormuz, I think it's Congo. I think my geography is horrible. But when you add in, and I know that they have applied, so when you add in Ethiopia and Saudi Arabia and Egypt, and they control the Straits of Hormuz, they control the Red Sea, they control the shipping lanes. Look at the infrastructure that is connecting all of the BRICS with the Belt Road Initiative and the North-South Corridor and all of these things that will allow transportation without interference by the U.S. Navy. It is a massive, massive undertaking that is accelerating. It's been 17 years in the works, but it's accelerating, and you can see things coming together, and you're right. And that's why I wasn't bummed out by it. I can see it very clearly. It wasn't time. And in crypto speak, they say mass adoption when the time is right. And that's exactly what you said. People say, I don't see anything. Well, our media does such a poor job of talking about this stuff that when I talk to people...
Andy Schectmen, a well-respected figure in the precious metals market, offers a compelling narrative on why 2024 could be the year when silver prices might see an unprecedented surge, potentially reaching as high as $805 per ounce. His insights, coupled with current market trends and geopolitical dynamics, provide a foundation for understanding the initial catalysts that might trigger this growth. Currently, silver is witnessing a notable increase in its price, recently crossing $28 per ounce, with projections from financial analysts suggesting a potential rise to $32 by the end of 2024. This uptrend is fueled by a combination of higher long-term inflation expectations in the U.S., significant government spending, and geopolitical tensions that drive investors towards safe haven assets like silver and gold. One crucial aspect that Schectmen points out is the increasing physical demand for silver, particularly from nations like China and Russia. These countries are not only major consumers but also significant producers of silver, thus tightening the global supply chain. The strategic accumulation by central banks, which have been diversifying away from the US dollar and into more tangible assets like gold and silver, further exacerbates this demand. Moreover, Schectmen highlights a critical market mechanic that could accelerate the price surge: the weakening of traditional price suppression tactics, such as futures contracts and naked short selling. These mechanisms have historically kept silver prices artificially low. However, with a growing insistence on physical delivery over paper claims and increasing arbitrage opportunities noted in markets like the Shanghai Exchange, where silver trades at a premium, these suppressive strategies are losing their grip. The backdrop to these market dynamics is the broader economic and geopolitical landscape. Countries and central banks are ramping up their silver and gold reserves as part of a de-dollarization trend, seeking stability and security in precious metals amid a volatile global economy. As Andy Schectmen frequently emphasizes, the strategic importance of silver is becoming increasingly apparent on the global stage, particularly as geopolitical shifts reshape the economic landscape. In 2024, these factors are expected to further drive the demand for silver, potentially catapulting its price to unprecedented levels. Countries, especially those within the BRICS consortium, Brazil, Russia, India, China, and South Africa, are making significant moves to reduce their reliance on the US dollar. This pivot is largely driven by the desire to buffer against economic sanctions and financial market volatility, often exacerbated by geopolitical tensions. For instance, China's aggressive accumulation of gold is part of a broader strategy to enhance its economic sovereignty and reduce its vulnerability to US policies. This trend underscores a similar trajectory for silver, as it also serves as a hedge against currency devaluation and economic uncertainty. In the context of silver, the growing industrial demand is particularly noteworthy. Silver is indispensable in various sectors, including electronics, solar panels, and medical technologies, among others. As nations like China and India continue to industrialize and expand their technological sectors, the demand for silver, due to its conductive properties, is expected to skyrocket. This industrial demand complements the investment demand, creating a dual pressure that tightens available supplies. Additionally, the ratio of gold to silver prices, which Schectmen points out, often signals significant market adjustments. Historically, when the gold-to-silver ratio widens significantly, it indicates that silver is undervalued compared to gold. This disparity has been noted by market analysts and could lead to a market correction, favoring a sharp increase in silver prices as investors seek to capitalize on this undervaluation. Furthermore, the weakening of traditional price suppression mechanisms in the silver market, highlighted by Schectmen, suggests that the market is gradually transitioning towards a more genuine price discovery process. This transition is crucial because it reflects a market less manipulated by large financial institutions through derivatives and more influenced by actual supply and demand dynamics. These geopolitical and economic shifts are not isolated but are part of a global realignment that affects commodity markets worldwide. As nations increasingly turn to tangible assets like silver to secure their economic future, the rush for silver could suddenly intensify, driven by both necessity and strategic positioning. This potential rush is precisely what might trigger a dramatic rise in silver prices, aligning with Schectmen's prediction for 2024. Building on the insights and market dynamics discussed by Andy Schectmen, the potential surge in silver prices to $805 per ounce in April 2024 hinges on a culmination of economic events and shifts, often referred to as the Great Reset, where the traditional global financial structures could see a significant realignment. This scenario involves the possible collapse of the US dollar as the world's primary reserve currency, a situation that would drastically alter global economic and financial landscapes. As we edge closer to 2024, the increasing de-dollarization efforts by major economies, especially within the BRICS nations and other emerging markets, suggest a growing unease with the dollar's dominance. These countries are not only accumulating gold and silver, but are also exploring alternatives to the dollar for international trade and reserves. This shift is crucial as it reduces the global economy's vulnerability to U.S. monetary policy and potential economic sanctions, thereby enhancing financial stability in other sovereign nations. Schectmen points out that the adoption of precious metals as a reserve by central banks is a defensive maneuver against inflation and currency devaluation. As confidence in traditional fiat currencies wanes, particularly the U.S. dollar, the intrinsic value of silver, both as a financial asset and an industrial commodity, becomes increasingly attractive. This heightened appeal could lead to a rush on silver, as both institutional and retail investors seek to hedge against inflation and preserve wealth in a more stable and tangible form. The potential trigger events for such a dramatic increase in silver prices could include further escalation in geopolitical conflicts that undermine confidence in fiat currencies, a significant downturn in major economies, leading to aggressive monetary easing and consequently inflation. A breakthrough in technological applications for silver, increasing industrial demand beyond current projections. A critical point in de-dollarization, where a significant bloc of nations formally reduces their dollar holdings or launches an alternative reserve currency. In such a scenario, the demand for silver would skyrocket, not just for investment purposes but also for its indispensable industrial uses. This dual demand could strain the supply, particularly if mining output fails to keep pace with demand, due to operational challenges or political instability in key producing countries. Finally, Schectmen often emphasizes that silver is more than just a store of wealth, it is wealth itself. In a world where the dollar's value could potentially crumble, silver's role reverts to that of a primary currency, not just because of tradition, but due to its inherent value and utility. This perspective is crucial for understanding why the projected price surge is not merely speculative but grounded in a profound economic paradigm shift, making 2024 a pivotal year for silver and potentially for the entire global financial system.
It started to dawn on me that this is changing now. So why is it changing? It's changing because for 17 months in a row, China has been accumulating gold. And there was a report by BMO, an analyst at Bank of Montreal, that said the numbers that they're giving us, and Russia too, are, we believe, way below what they are actually accumulating. Not to mention they're the largest producers of it in the world. You look at what's happening in Switzerland, the export numbers coming out of the refineries, massive amounts, all going to China and to Russia and to Saudi Arabia and to these countries that ironically are in the BRICS. You look at what's happening on the Shanghai Exchange. On the Shanghai Exchange, you see silver priced at roughly $3 an ounce higher, over $30 in China, and gold 70, $80 higher. This is the arbitrage knob we've been talking about, slowly turning up the arbitrage so the traders who have access to the LBMA, who have access to the COMEX and to the Shanghai Exchange can purchase in the West and deliver in the East. So what I am getting at is that I truly do believe, and that's why I say it feels different this time, that there is a possibility that they have lost control, they being the West, of being able to suppress the price of gold with naked futures contracts. They realize, perhaps, I'm not sure on this, but it sure feels that way, that they realize naked shorting copious amounts of gold and silver when the rest of the world is not only massively accumulating it, as the central banks have been doing for the last 3 years at record levels, mind you, but that there are willing participants willing to pay huge premiums to the fictitious, if you will, Western paper price and take delivery of it in China. And by naked shorting, you're ending up, I guess, setting up an infrastructure as dumb as a mud wall in a rainstorm. Because if all of a sudden these countries continue to stand for delivery, continue, gimme, it can bankrupt a company. And if you don't believe that, just go back and listen to Chris Marcus's podcast with Bart Chilton, who admitted a week before he died that Bear Stearns went bankrupt because of silver going to $21 an ounce from $9, because they had such a massive short position. It bankrupted them. So I guess what I'm simply saying is this. For my entire career, my entire life, the COMEX market has controlled the physical market. The paper market has controlled the physical market because of the leverage and because of the fact that very few, less than 1% of all contracts issued stood for delivery. Now, in a world where we see massive industrialization and wealth in the countries that are accumulating it all, like China, like Russia, like Saudi Arabia, like all the countries in the Middle East, like all of the countries in the BRICS that are growing in their wealth and in their middle class and in their industrialization. It's a different world. And they know that gold is remonetized.